welcome to today's Explainer. Today, we're diving into something I like to call the architecture of financial trust. Look, it's a system that pretty much dictates our entire economic lives, right? From the homes we buy to the very foundation of our long-term financial security. But instead of treating this like some big guarded secret, we're going to decode the exact nuances of how the modern financial algorithm measures and, honestly, monetizes your reliability. To really ground this, just picture this scenario. Two 25-year-olds walk into a bank. They're both after an auto loan. They have the exact same salary, and they want the exact same car. But here's where it gets crazy. One is approved instantly, locked in with a beautiful premium interest rate. The other, rejected outright. Same age, same income, completely different outcomes. Okay, let's dive into this. So what actually made the difference here? Well, it absolutely wasn't their income, their job title, or where they came from. Nope. The entire discrepancy comes down to a single, incredibly powerful mechanic that's just quietly working in the background, constantly quantifying their financial behavior. And that hidden mechanic, as you've probably guessed, is the credit score. But hold on. Rather than just seeing it as some random, complex math or a three-digit number, I want you to think of it as your financial reputation score. It's a highly optimized, completely logical metric designed by lenders to answer one very specific, absolutely vital question. What is the statistical probability that this individual will actually pay back borrowed money? Section 1. Defining financial trust. See, lenders need a structured way to gauge your long-term behavioral reliability. It's kind of like how a teacher builds an opinion of a student over a whole semester based entirely on their day-to-day habits. I mean, think about risk assessment from the lender's point of view for a second. Would you rather lend your hard-earned cash to someone with a flawless, perfect track record of paying people back, or someone who's constantly always missing deadlines? The answer is a no-brainer, right? Well, financial institutions rely on that exact same fundamental logic. A credit score simply formalizes it. It lets lenders estimate risk super efficiently before handing over any capital. So higher score, that equals established trust. Lower score, that just tells them there's a higher statistical risk. Section 2, the building blocks. Okay, let's roll up our sleeves and investigate the specific factors that these algorithms actually use to quantify this trust. The core algorithm relies on a very specific recipe, made up of 4 key factors: payment history, credit utilization, credit history, and new applications. By breaking these overarching components down, we can see exactly how your everyday financial decisions literally translate into a mathematical score. Because at the end of the day, consistency builds confidence. Now, what's really interesting about this slide is how heavily weighted your payment history is. It's the biggest factor. It asks a simple, binary question. Do you meet your obligations on time? It perfectly mirrors academic reliability. You know, a student submitting assignments before the deadline earns institutional trust, right? Well, your track record of meeting financial deadlines is the absolute non-negotiable foundation of your score. Missed payments directly signal on reliability to the algorithm. Next up is credit utilization. Simply put, this is the ratio of your outstanding balances compared to your total available credit limits. Think of it this way. Using $900 of a $1,000 limit signals this heavy, ongoing dependence on borrowed money. It's a huge red flag, and the algorithm instantly flags it as high risk. Conversely, if you're only using $200 of that exact same limit, it demonstrates serious restraint. It proves to the bank, hey, I have access to credit, but I have the discipline not to max it out. Then we have the length of your credit history. Honestly, this just comes down to the sheer volume of available data. 10 straight years of working responsibly with your money, that proves your trustworthiness over a broad, undeniable timeline. On the flip side, an account you just opened last week simply hasn't existed long enough to give lenders any sort of reliable behavioral pattern to evaluate. The final primary factor involves new credit applications. Look, if you're applying for 10 different loans in one single week, that is going to raise some massive alarm bells in the system. To lenders, it looks like you might be going through some sudden, unpredictable financial stress. They start questioning why you suddenly need so much credit, which is exactly why frequent clustered applications will temporarily lower your score. Section 3, the cost of credit. Now we're getting into the real-world consequences. Let's look at why managing these specific mechanics matters so much for your long-term financial stakes. Think about applying for a major loan, like a mortgage. A higher score secures a lower interest rate. Now, a 1 or 2% difference might sound tiny, right? But man, to put that into perspective, that difference balloons drastically over a 20 or 30-year term. depending on the size of your loan, that tiny rate difference can quite literally end up costing or saving you tens of thousands of dollars over a lifetime. It's wild. Which brings us to a super dangerous, lingering myth in personal finance: the idea that avoiding credit completely is the absolute safest route to an excellent score. So many people assume that having zero debt automatically makes them a prime candidate for future borrowing. But in the architecture of financial trust, that assumption is entirely false. The reality is summed up perfectly by the foundational logic of the algorithm. Without financial activity, there's often little information to evaluate. It's like a student who literally never takes a test. The teacher, or in this case the bank, simply doesn't know how to grade them. If you completely avoid credit, you aren't generating any behavioral data. The algorithm doesn't default to a perfect score. It defaults to a non-existent one. Section 4. Fixing financial mistakes. Now, if you're stressing out, take a breath. The really great news is that mistakes like missing a payment or maxing out a card don't have to ruin your score forever. The steps to heal a damaged score are clear, and more importantly, they are totally actionable. Number 1, pay your bills exactly on time. Number 2, actively reduce your outstanding debt to lower that utilization ratio. 3, use your available credit sparingly. And 4, maintain complete consistency. The algorithm is weighted to prioritize your recent behavior. So by stacking responsible actions month after month, you gradually overwrite past mistakes and steadily rebuild your score. You've totally got this. So, the crucial point is that credit scores aren't actually a measure of your wealth or your income. They really aren't. They don't track your salary or the size of your stock portfolio. They are simply a mirror reflecting your behavioral habits. Responsible, predictable patterns naturally lead to stronger scores regardless of your actual income. Let's move to and see how this builds back to our two 25-year-olds from the beginning. Remember them? Well, solving the mystery here is easy now. The difference in their outcomes at the bank had absolutely nothing to do with wealth. Nope. It was entirely about the consistent, undeniable track record of financial trust that one of them had quietly built up in the background, while the other hadn't. Understanding this underlying architecture isn't just about securing one single loan. It's about actively taking control of the metrics that unlock a whole lifetime of financial opportunity. A credit score is so much more than just a number. It's a reflection of financial trust. So the next time you swipe your card, I want you to ask yourself, are you merely making a transaction today, or are you strategically building the trust that will unlock your financial tomorrow?